So we're ready to go? Okay. Hi again, this is Marianne, and I am going to now talk to you about the personal income statement. Income and expense statement is how they refer to it in your book. It's also called the personal cash flow statement. There are different names depending on the textbook. Don't worry about that. The important thing to remember is what we're looking at here are your inflows, which is money that flows in every month that you have available to spend. And then outflows, which are all your expenses. The bottom line from this is net cash flow. And net cash flow is really important. We'll talk about that in a few minutes. And then we're going to relate it to the balance sheet, which was the video that you should have previously watched. So we're going to relate the income statement to the balance sheet, and that'll be at the end of the video. So income statements are over some period of time, generally a month. If you're working in a business, you'd probably do it monthly, you'd do it quarterly, you'd do it annually. But for a personal income statement, what you're going to do is do this every month. And you're going to use this. This is really the actual results that you transfer from your budget. So we're going to talk about budgeting in the next video, and a budget is always a forecast. So you forecast your expenses for the next month, and then at the end of the month you go in and you put down what you actually spent and what you actually earned in that month, and then you look at the variance between the actual and the budgeted. So we'll talk about that in a minute too, or in the next video. But we've got a period of August 1 to August 31st here. And inflows are the first thing on the cash flow statement. So inflows are things like salary, wages, tips, interest income, dividend income, capital gains. You may not be familiar with those terms yet. Those are things that we'll discuss as we move through the book when we get into the chapters on investments, capital gains, dividends, and other types of income like that. Interest income you're probably familiar with from earning that on a bank account or something like that. So all the different types of income would go under inflows. And for your salary and your or wages, you're using the net income. So it's the amount that you actually get to spend. It's the number that's on your paycheck, the paycheck that is deposited into your account or that you cash at the bank. And then under outflows, we've got expenses. And so these are all the expenses for a month. So, you know what your expenses are. The usual expenses are things like rent or house payments, utilities, cell phone, cable TV, books, food, insurance, all of medical expenses, child care, all of those types of things would go under outflows. And then inflows minus outflows equals net cash flow. Net cash flow is either positive or negative. If you are spending less than you earn, then your net cash flow is going to be positive. If you are spending more than you earn, then your net cash flow is going to be negative. And everybody spends more than they earn sometimes. Typical months where you spend more than you earn would be August, when you start school and you've got to pay tuition and you've got to buy books. Christmas might be an example of that. There may be other months, maybe January as well, because you go back to school and you've got tuition and books again. So you might be spending more in those months than you earn. The thing is, through budgeting, you learn to plan for that so that you don't have to pull out that credit card and put those expenses on a credit card and incur interest. Through budgeting, we learn how to plan for all of the expenses that we have, because most people say that they had an unexpected expense when there are very few unexpected expenses, because you know these things are going to happen, you just fail to plan. So what you want to do is put yourself in the position where you are spending less than you earn, so you have positive net cash flow. So up here, if we have inflows of, let's say, $2,000 for a month, and all of our expenses total, let's say, $1,500 for the month, then our net cash flow is going to be positive. We're going to have $500 in positive net cash flow. If, on the other hand, we have $1,500 in income and $2,000 in expenses, then we've got minus $500 in net cash flow. So pretty easy statement to wrap your mind around. It's, whoops, I frequently drop my pens in class too. Pretty easy to wrap your mind around this because we're dealing with income and expenses and then the difference between that. So this isn't really a tough financial statement to really understand. What is important about this is that it does relate to the balance sheet. So in the last video, we went over the balance sheet and how total assets equals total liabilities plus net worth, and that we're really keying on net worth, and what we want to do over time is make this net worth grow. So the two statements are related because if you've got positive net cash flow at the end of every month, what you can do in order to build net worth over time is two things. You have a choice of increasing assets, and if you increase assets, so you put more money into savings, you put money into your 401k, which is a retirement account, or you purchase an appreciating asset such as real estate, or you invest in stocks, bonds, mutual funds, then over time, taking your positive net cash flow and investing it in assets will grow the amount of total assets. If you don't incur any more debt, then like I said, this net worth is a plug. So if you have larger assets, debt doesn't change, net worth has to go up. So positive net cash flow gives you the opportunity to increase assets. It also gives you the opportunity to decrease debt. So the first thing you should be doing is paying down your debt, especially if you've got high interest rate credit card debt. You want to get that paid off right away. And so all your positive net cash flow should go into reducing especially your high interest rate debt. And then as debt decreases, even if assets stay the same, as long as your debts are going down, your net worth is going to increase. So you can see that I've got positive net cash flow in blue, and I've got arrows pointing up for that correspond to the positive net cash flow. So for assets, increasing assets leads to increasing net worth. Decreasing debt leads to increasing net worth. The other side of the coin is if you spend more than you earn, you're going to have negative net cash flow. So if you've got negative net cash flow, what are your options? The money doesn't just fall out of the sky or grow on trees. You can't go out and pick it in the backyard. So you've got to do something, and you basically have, again, two options. If you've got any savings, you deplete your savings. If you continually spend more than you earn, you're going to deplete all your savings. That's the first thing you'll probably do. And so what happens is that your assets decrease. Savings evaporates. Your checking account has no balance in it. Any other types of savings that you have will be depleted. At the worst case, you start selling real assets. Maybe you sell your car, or you sell something that's of value to you so that you can have additional cash because you're overspending. The other option is to increase debt. This is what most people do as well, and that's pulling out a credit card. So what people will do when they continually overspend is they will pull out a credit card and they'll max it out. When they've maxed out that credit card, they apply for another credit card. They max that one out. Then they'll apply for another one, they'll max that one out. So they're always trying to make their minimum payments. Well, eventually, if you are continuously overspending, you're not going to be able to make the minimum payments. So you've depleted your assets. Now you've got more debt than you can handle. And you are in negative net worth territory. So negative net worth and negative net cash flow, that's how people head into bankruptcy. So if you are continuously overspending, that should be a huge red flag. If you are borrowing from the payday loan places or borrowing money from friends or family members on a regular basis, that's a huge red flag that you are in trouble, and you need to assess your situation and look at your behavior, because there's a reason why you're doing that. And you have to figure yourself out, because the spending more than you earn is just a symptom of a deeper problem. So you can survive negative net worth. I did. My family did. Everybody pretty much starts off with negative net worth because most of us have guaranteed student loans that we have to pay off. But the key is, what you want to do is have positive net cash flow. If you've got negative net worth but positive net cash flow, you can keep your head above water. And you can systematically attack your debt and pay that down. And then you can start building assets. And when you do that, you end up with positive net worth, and that increases over time. And what you want to do with that positive net cash flow after you've paid down debt is invest in appreciating assets. That means that BMW you've always wanted to drive, don't make that your first car right out of college. It's too expensive. I'm not saying that you can't have a BMW someday, but take care of all your goals. Write your goals down, write your financial goals down, write what you want to accomplish for yourself and for your family. And when you've done all of that, reward yourself. Go ahead and buy the BMW or whatever car you want. I love to travel. That's one of my luxuries. And so I plan for that. And I sacrifice in other areas that don't mean that much to me so that I can travel. Because I just love experiences. Everybody's different. And so personal finance is exactly that. It's personal, and you get to decide how you spend your money. But I can tell you that everybody needs to spend less than they earn, because if you don't, you will end up in this consistent negative net cash flow situation, and that will eventually lead to negative net worth and bankruptcy. So that's it. For the income statement, and how these two relate is vitally important. You can bet your life that that will show up on the test for this unit. So make sure you understand how the income statement relates to the balance sheet. And that's it. Thanks.